What if I told you that most people sitting in the stock market right now, checking their portfolios 5 times a day, refreshing their trading apps, what if I told you they're not investors at all? They're gamblers. They just don't know it yet. Warren Buffett has a brutal, one-question test that separates real investors from people who are simply gambling with extra steps. And today, I'm going to give you that exact test. By the end of this video, you'll know, with complete certainty, which one you actually are. Stick around till the end, because I'm also going to show you how this test applies directly to Nifty and Sensex investors, and what it means for your SIP strategy. Let's get into it. Welcome back to Master Investor Mindsetter, the channel where we decode the mind of the greatest investor alive, Warren Buffett, and his partner in genius, the late Charlie Munger. If you're new here, hit subscribe, because every single week we break down how Buffett thinks, so you can apply that thinking to your own money, whether you're investing 10,000 rupees a month or 10 lakh. Now, let's talk about gambling and investing, and why most people can't tell the difference. Here's the test, straight from Buffett's own philosophy, something he's repeated in various forms across decades of shareholder letters and interviews. Ask yourself this single question. If the stock market closed tomorrow, and didn't reopen for 5 years, would I still want to own this? That's it. That's the whole test. If your answer is, absolutely not, I need to sell this thing the moment the price moves, congratulations, you're gambling. If your answer is, yes, because I understand this business, I believe in what it does, and I'm happy to own a piece of it regardless of what the market says tomorrow, that's investing. Buffett has said that he buys stocks the way he'd buy a farm or an apartment building. You don't check the price of your farm every single day. You don't panic sell your apartment building because your neighbor's house sold for less this month. You hold it because you understand its long-term value. Gambling, on the other hand, is about the next number on a screen. It's about reaction. It's about adrenaline. Buffett has been blunt about this. Markets, especially in the short term, can behave like a casino. People aren't buying businesses anymore. They're buying tickers. They're buying momentum. They're buying because a stock went up yesterday and they're scared of missing out today. That's not investing. That's the same psychology as a slot machine. Here's the key difference, and I want you to really sit with this. A gambler is betting on what other people will do next. Will the price go up because more buyers show up? Will it go down because of panic? It's a bet on crowd behavior. An investor is betting on what a business will actually produce, in earnings, in cash flow, in value, over years. Buffett's famous quote captures this perfectly. The stock market is a device for transferring money from the impatient to the patient. Read that again. From the impatient, the gamblers, to the patient, the investors. Let me give you 3 signs that you might be gambling, even if you call yourself an investor. Sign number 1. You can't explain what the company actually does. If someone asked you right now, what does this business actually sell? How does it make money? Who are its competitors? And you can't answer in 2 sentences, you don't own a business. You own a lottery ticket with a stock symbol. Sign number 2, you check the price more than you understand the business. Buffett spends his time reading annual reports, understanding competitive moats, studying management quality. He doesn't spend his time refreshing stock tickers. If your daily routine is 90% price checking and 10% research, that ratio is backwards. Sign number 3. A 10% drop makes you want to sell. If a stock falling makes you want to run, but you wouldn't have bought more at that lower price, that tells you something important. You weren't investing in the business. You were investing in the feeling of it going up. Buffett and Munger both built their fortunes by doing the opposite, by getting more excited when great businesses became cheaper, not less. Now let's bring this home, specifically for those of you investing in the Indian markets through Nifty, Sensex, or your monthly SIPs. This test is especially important in India right now, because we've seen massive retail participation flood into the markets over the past few years. New demat accounts, new traders, new SIP investors, many of them have never lived through a real prolonged downturn. So ask yourself the Buffett test using Indian context. If the Sensex fell 30% tomorrow and didn't recover for 3 years, would you still be comfortable holding your current portfolio? Would you still believe in the businesses you own? If you're invested in a fundamentally strong company, one with real earnings, real market position, run by competent management, a market crash doesn't change the value of that business. It just changes the price for a while. But if you bought something purely because it was trending on social media, or because a friend made quick money in it, or because the chart looked good, a downturn is going to expose that immediately. You'll panic, because there was never a real business thesis underneath your decision. There was only price momentum. This is also exactly why SIP investing works so well for most retail investors. It removes the emotional, gambling-style decision-making. You're not trying to time the market. You're systematically buying quality over time, regardless of short-term noise. That's about as close to Buffett's mindset as a regular retail investor can practically get. So here's how you apply the Buffett test starting today. Before you buy anything, stock, mutual fund, anything, ask 3 questions. 1. Do I understand how this business actually makes money? 2. Would I be comfortable owning this if the market shut down for 5 years? 3. If the price fell 40% tomorrow, would my reasons for owning it still be valid? If you can answer yes to all 3 with genuine confidence, you're investing. If you're hesitating, or your honest answer is, I just think the price will keep going up, you need to pause and rethink that position, because that's gambling, regardless of what app you're using to do it. Warren Buffett didn't become one of the richest people on the planet by predicting next week's price movements. He became wealthy by understanding businesses deeply enough that short-term price swings simply didn't scare him. That's the real takeaway here. The goal isn't to predict the market. The goal is to understand what you own so well that you don't need to predict anything at all. So next time you're about to hit that buy button, stop and ask yourself Buffett's brutal question. It might save your portfolio. It might save you years of stress. If this video gave you some clarity today, smash that like button and subscribe to Master Investor Mindsetter for more no-nonsense breakdowns of how the greatest investors actually think. Drop a comment below. Be honest, are you investing, or have you been gambling? I read every single one. See you in the next video.